Hey YouTube, this is Zach with Achilles Financial, and today I'm going to come back to talking about bonds and where I think bonds are going to go from here. What I have here on the screen is SPY, which is a S&P 500 overall market overview, and today we hit all-time highs for yet again. The reason that I highlight this is because right now there is a series of kind of back and forth information that we're looking at that has kept bonds somewhat muted, which per the last video when I talked about this, is keeping some of that growth constrained. However, due to the fact that there is some subsidizing inflation fears, as well as the fact that there is still a lot of money being pumped into the economy, which those two items back and forth kind of don't necessarily benefit each other, there is a lot of optimism going into the market. Now, when we look at a summary just to explain kind of how the portfolio is performing from a overall market perspective, you can see that from April until January of this year, or I guess right now a full year, we have seen incredible growth in the indices. Granted, keep in mind that at this point in time, we are right at 1 year from a COVID mark or response. So this has been monumental growth. The other thing that I want to highlight here, if we look at just another kind of indices that we can look at, would be IWM, which is the Russell 2000. So SPY tracks the S&P 500, which again are some of the larger companies in the United States or abroad. iShares Russell 2000 is taking in a lot more of what used to be just the small caps, but is now kind of a better measure or metric of the overall portfolio performance for the broader market, because it takes into account a lot of the smaller companies. So if we were to look at portfolio, you can see some of the companies that are included in here are Plug Power, Penn National Gaming, Caesars Entertainment, and some of these other companies in here that have grown quite rapidly. But I think it's important to look, if you look at a cash flow or book to value growth, maybe not the growth side, but the valuation, an entire indices is currently trading at a price to earnings ratio of 20.28. The reason why that's important is because this is the highest price to earnings valuation that we've seen in this portfolio. Now keep in mind right now we're looking at a as of 226. Since 226, this portfolio has continued to go up. So since back during this time period right here, we're actually about break even. But that being said, I am still looking at this recognizing that it is overvalued. Now, one of the things that this impacts is definitely the bond market and why big money may be making that return to bonds. So for example, if we look at some of the companies in here that, again, if we're just picking one at random. So with these companies trading at such high multiples, it's important to note that there is a lot of room to fall. A company that we'll look at here just to explain some of the higher multiples, if you look at Sunrun, which has seen a large uptick in particular today, noticeably in line with the clean energy wave that we are seeing happen. If you look at the valuation of the company, you can say that this is a company that's trading at nearly 2 times what the broader industry is doing. But historically, this is significantly ahead of where companies trade. Keep in mind that this has a non-existent PE ratio because that means that they are not profitable. So instead, they're using the price to sales ratio of 11.4. That means this company is trading at 11.4 times their total sales. So their market cap is significantly higher. The reason why I think that that's important is because companies like this have a lot further to fall in adverse economic scenarios. So there are some huge companies out here. Again, I'll take into account a company that kind of gets always highlighted here of Tesla. If you look at the valuation, and this is not as of today, I don't believe. I don't see the exact date associated with these valuations. But you can see that the price to earnings ratio, because they are profitable, is I think now actually closer to 1,050 based off of this share price. And you can see their price to sales is nearly 20. All of this is to highlight that whether you agree with how the company performs or not, at the end of the day, without the sheer amount of liquidity in the markets, the amount of cash that's going into play and leverage as well, these companies are only able to function by a basis of what they produce. So if we take away some of that air in that bubble, what are you left with? For that reason, we've seen big money migrate from these more speculative stocks with larger gains to safer money. The concept behind this is if you make a lot of money, you are actively encouraged to keep some of those gains. So generally speaking, a portfolio advisor will help you with this, move it to bonds. Now, generally speaking, if you are working one-on-one with a portfolio advisor, you're not going to be making huge moves. However, a mover like Fidelity, Goldman Sachs, or a massive fund or a pension fund is going to have the capability to move these markets. So if you actually are in the TD Ameritrade platform, you can go into the bonds and CDs website or overlay and take a look at what people are paying for. If you if you are utilizing a 401k plan through your company today, odds are that they are engaging in some form of bonds for you. That being said, if we take a look at this, you can see that there's a number of different types of bonds available in here. Again, there's also CDs, which is certificate of deposit. That'll be for another video. But the one that is making the most noise right now is the 10-year bond. So you can see the 7 to 10 year and the 10 to 20 year. So if we look at the 7 to 10 year bond, and the 10 year is the one that a lot of people are talking about, you can see right here, 10 year, this 1.729 is what everyone is going crazy over. So this number right here in a not super user friendly approach for bonds is what is making the market go wild. And the reason for that is because if you look at this, you can see that the coupon note is 1.125. That's basically the premium associated with the loan, and you will get paid semi-annually. So this is fixed in terms of the amount of times that you will be paid, as well as the amount you will be paid. And the reason that this is important is because this is guaranteed income. So if you have a lot of money, and especially if you don't need access to it right now, and you invest $100,000 into the market, you will be paid right at $900 every or just underneath that, $900 twice a year. So why is that important? Well, obviously, if you have $100,000 and you are not close to retirement, you probably aren't going to be wanting to shift that over into the bond market. You want to put that to work. However, there are funds out there that are managing trillions of dollars, and they just went off of the most rapid increase in market price history over the course of the past 12 months. So what's happening here is as these yield rates rise, as inflation fears occur, as people get worried, they're saying that instead of keeping my money in a much more speculative asset like stocks, or trying to go out and buy real estate, which is also at all-time highs, I want to get paid, and I can do so on a semi-annual, or some of these you can do annual or monthly basis. This is the attractive nature of it. Again, this is not as easy and user-friendly as, generally speaking, the stock charts and such is why a lot of retail investors are not utilizing this. But you can see right here that 1.72% is the one that people are watching and going over. The reason that I want to highlight some of this information is because you can see that this is a total market approach in what you're utilizing. From a bond calculation perspective, just to highlight some of the moves that this is making and what's actually happening, they do utilize a bond calculator that we can pull up and we can look through. So as you can see, we've pulled up the quantity capabilities here. Just want to highlight, you're probably not just buying one. If you walk through the calculate option right here, you can see that your yield to maturity on this particular bond is going to be 1.125. The reason why these are attractive is you can see the yield to worst. So your worst case scenario is still 1.125. You've got $142 of accrued interest, which means that you essentially made that 1.125. So your total amount is $100,142. So this is why bonds are attractive, is because it is guaranteed money. Now, is this something that I'm personally investing in? No. I like my stocks, I like my ETFs, and I like to aggressively go after them. However, this is why it's important to at least note and to look at the fact that bonds are continuing to put downward pressure on the market. You can see that this rapid rise that's occurring right now is a huge deal. The reason for that is because people are worried about inflation, and they know that this is going to continue to put downward pressure on stocks and upward pressure on treasuries. So if my guaranteed is capable of eclipsing what was a speculative asset, then that makes it a lot more beneficial for me. As you can see, the 10-year right here is 1.71. If we actually go and we look again at SPY, which is kind of that metric that we are utilizing, you can see right here that the distribution yield, which is the dividend you would be receiving from SPY, is 1.50. Now, do we think stocks are going to continue to go up over the next 10 years? Yes. However, I can get a guaranteed 1.72% return compared to a guaranteed 1.5% return. And that's a great benefit compared to what could happen, which if you had bought bonds in 2008, right before the market crash, and you were close to retirement, you probably would have felt a little bit more comfortable. Keep in mind, you don't have to buy the 10-year. So this is just something to consider going forward as to why this is happening. All of this being said, I do think that the bond rates are going to continue to go up. I think tomorrow morning, it is March 31st, I think they will start going up tomorrow morning because we did see a new infrastructure plan that is going to require additional spending. Because of that additional spending, I anticipate that we will see some downward pressure on stocks and upward pressure on the bond yields. All that being said, this is what I'll be watching tomorrow, and interesting to see how it will affect my tech-based portfolio. So if you want to know more about this, feel free to like and subscribe. Feel free to join our Discord as we talk about this type of information on a regular basis. And if you have any comments, please drop them down below. Thanks. Talk to y'all later.